The unbearable weight of AI and chip stocks on the U.S. equity market. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S., and nobody wants to get out in front of the jobs report tomorrow, and that is why the S&P 500 is little changed right now. Of course, we are taking a breather from yesterday's record highs in the S&P and in the NASDAQ. Not a whole lot of action in the Treasury market either, with the 10-year currently yielding 4.27%. Now, within the Magnificent Seven, you can see it's a flat line, but it's interesting because one of the best performers of that group, NVIDIA, is down today as Bloomberg reporting that the U.S. government has opened antitrust investigations into NVIDIA as well as Microsoft over their dominance in AI. We'll have details on that shortly. And NYMEX crude moving up by more than 2%, continuing to rebound from a 4-month low. Romaine?
Yeah, we talk about the broader market, though, as we kick you off to the close here, a day after that record rally, and the navel gazing begins as investors really do assess whether to cash in their chips or double down on hopes for further gains. Scott Rubner, Goldman's main tactical specialist, telling investors to actually hold on tight in preparation for what he sees as a flood of cash in early July from passive allocations into the stock market, saying the bar right now for being short equities is very high given these upcoming flows. Now, whether Rubner is proven right depends on where that money actually flows. Right now, it's still just going into big tech and increasingly into big chip. NVIDIA's $3 trillion milestone yesterday doubled its weight in the S&P this year to 6.7%. Semiconductors as a group now with a 12% weighting, overtaking software for the first time in 2 decades. But Stephen Whiting over at Citigroup's Global Wealth Management business sees hope on the horizon, saying while big tech has almost single-handedly powered the market in the first half of the year, continued economic strength and profit growth in non-tech sectors should broaden equity returns through the rest of 2024.
Profits are picking up around the world, and you don't need to limit yourself to a few tech companies, I think, looking forward.
And you can see that right here. That's why some people see opportunity in sectors beyond technology. The white line in this chart is the S&P 500. It's the market cap weighted index. Of course, that means the Mag 7 names minus Tesla are driving that 12% gain so far this year. The blue line, the one underneath, is the S&P equal weight index, which gives equal weight to all the constituents from number 1 to number 500. And it trails with a rise of about 4.33%. That gap, you can see there, is set to shrink as the earnings tide turns, with other sectors now on track for a profit recovery by the end of this year. Romaine?
That's the big hope here as we kick things off to the close. Joining us right now is Lisa Shalett, Chief Investment Officer at Morgan Stanley Wealth Management. And Lisa, there's been a lot of talk here about the big run-up that we had to start this year, whether that continues through the rest of the year in order to see those additional gains. And I think this is what Scarlett was getting at. The fundamentals have to be supportive. Do you think they will be?
Look, I think the path of least resistance between now and the end of the year is for the market to grind higher. I do believe that we are going to see an improvement in breadth with more sectors participating as corporate profits do improve a bit here. But at the same time, I think we have to have measured expectations. This is a market that's already up 11% year to date in a year, assuming we believe that the current valuation multiples are reasonable. We're already up 10% in a year when we're forecasting roughly 10% year-on-year earnings growth. So all the gains from here are going to start borrowing from 2025 and the expectations for the year forward. So I think we have to have measured expectations that the second half of the year may not be as strong as the first half. But like I said, I do think we grind higher from here.
It's funny you mentioned 2025 because I've already talked to some folks that are already looking at 2025 to justify the valuations here, not even at the midpoint in 2024. Lisa, we have to talk about the elephant in the room still, which is the Fed and interest rates. And who knows what we're going to learn next week when they do have that meeting next Wednesday. But do you think we'll, at minimum, if not necessarily get rate cuts, we'll at least get clarity on the path forward?
I don't know that we're going to get clarity. And the reason, Romaine, is simple. The data is not clear. And this is a data-dependent Fed. And let's just think about the data that we got in the last week or so. On the one hand, it seems like services are doing okay. On the other hand, manufacturing disappointed. Looks like the labor market is cooling a bit, but it's moving into balance. Does that mean that wages, stay on a solid footing, or they weaken from here? I think this is really a lot of cross currents, and I don't think that the Fed's going to have it figured out in the next week.
Yeah, probably not. And that's in large part why you see almost no movement in the index when you look at everything right now, because no one wants to get in front of that big data point and in front of the Fed next week. Do you buy into this idea at all that there is a wall of money waiting to flood into U.S. equities come July, that the flows are going to go straight to passive funds and just, keep everything lifted?
That's not what we're seeing. Our perspective is that investors broadly are pretty fully invested. You noted how hard it is to, quote unquote, be short this market. And I think most of the professionals in the hedge fund community and the institutional community are well aware of that. They have not been fighting the tape, and they're not short this market. So positioning is full, valuations are full. We have a look at a large swath of the private wealth, cash on the sidelines, and we're much closer to averages than not. So while there certainly is money sitting in money market funds, that 5.4% is still reasonably juicy. Especially if you believe that, the second half of the year is going to be a grind. So I don't see a flood of cash coming in this summer, given the cross currents, given the uncertainty, given things around the election, given the geopolitical instability out there. You noted some of the elections, that are occurring around the world. I think there's a lot of reasons to doubt this tsunami of cash thesis.
Clearly, the elections, especially in the emerging markets, we're talking about Mexico, India, took a lot of investors by surprise. It defied the consensus. Do you worry that there's something like that could play out here in the U.S.?
Well, I'm not really sure that U.S. stock markets have positioned for the U.S. presidential election quite yet. I think one of the things that has been fascinating over the last, 5-6 years is, how, we don't discount based on polling anymore. The market really waits until it knows the facts when it comes to elections. And even then, it may take a few days of counting. So, I worry that there may be instability. I worry that there may be surprises, but I don't think we're going to know that. And I don't think the market's going to price it until election day itself. And even then, it may take a little longer.
All right, Lisa, always wonderful to talk to you. Lisa Shalett there over at Morgan Stanley Wealth Management, helping us kick you off to the countdown to the close. Coming up in just a bit, a focus on the oil market here, with oil prices still hovering right now around $76 a barrel. Paul Sankey, lead analyst at Sankey Research, actually sees a path down to $50 a barrel by the end of next year.
That'd be relief on the inflation front. Plus, Shopify no longer a buy, according to MoffettNathanson. We're going to speak with the analyst who sees a bumpy road ahead for the e-commerce platform.
And a closer look at the market moves today, a closer look at the potential reaction tomorrow ahead of a big jobs report. Lauren Goodwin, economist and chief market strategist in New York Life Investments, going to be stopping by the big program. All that and more coming up in a bit. This is The Close on Bloomberg.
Oil edging higher for a second day, continuing to rebound from 4-month lows, with the Saudi energy minister warning that OPEC Plus's planned production changes can always be reversed. But our next guest says, based on what he's seeing in the latest OPEC Plus communique, oil is headed down to $50 a barrel by the end of 2025. Let's bring in now Paul Sankey. He is lead analyst at Sankey Research. Paul, let's first go over what it is that we learned from OPEC Plus this week. I'm confused because they kind of made it clear that they would loosen production quotas, they would add more supply. Now they seem like they're reversing course and saying, you know what, that could always change. So net, what happened?
Well, I think that we've been concerned for a long time now, at least a year, about OPEC's spare capacity. I think everyone's very aware of it, obviously, because OPEC has cut back production. And the question has always been, when will they be able to get back into the market with higher volumes and, hold less spare capacity? The really frustrated member is UAE. And we've been very focused on UAE because historically UAE always acts absolutely in concert with the Saudis and is absolutely reliable in terms of what they do. But in this latest communique that you referenced, the UAE is essentially given a path towards increased production over the coming year. And that becomes, in the case of the UAE, because they have such huge reserves of oil, a path for future growth from the UAE at the same time as non-OPEC, led by Guyana, is growing. So there's a real concern about oversupply here, which is essentially, I'm finishing, I promise you, is essentially why the Saudis urged people to remember that they could always reverse cuts because the market reaction was so negative to the initial news.
So it sounds like the Saudis were warning UAE and Guyana more than the oil market.
No, I think that what they were saying is, look, we've said that there's a path back here to 2.2 million barrels a day of incremental supply, right? Global oil demand growth is around 1.3 million. So at face value, that's, more double the supply coming back into the market than the entirety of global demand growth next year. And that had to be clarified. And what they're really saying is that Saudi won't put 1 million or more, could be 2 million if they really push it back into the market. Don't worry about that. And that they'll also try and maintain the other members to respect the makeup volumes that they promised, for example, where they would actually cut additional volumes to make up for cheating in the past. So, they're essentially saying, don't just read this as a 2.2 million addition with a given schedule. It won't work like that, which is a fair comment. And the market has rallied on that, and also it being summer.
Yeah. Paul, I am curious here, and I just want to bring this back home to the U.S. because, of course, we have our own supply and capacity issues going on right now. I am curious that when you consider where we are right now in the U.S. in terms of output, where some of these oil companies have telegraphed where they want to go with that output, how much is that going to have an effect on prices?
Well, it's really the capex, right? So they're being very disciplined in capex, and the concern is that because they're disciplined with oil at, let's say 120 during the Russian invasion of Ukraine, so they're not going to immediately cut capex if prices go below probably 70 Brent would be a point of extreme pain. So first of all, they're much more stable in their plans, but some of them, like Chevron and Exxon, do have volume growth plans for the Permian, and are probably really quite strongly going to try and meet those volumes, unless, again, the oil price is an awful lot lower than where it is today. As you know, a lot of them claim $5-ish type break-evens, which is always a questionable number. But, the potential is for oil to have to go way down in order to correct U.S. growth, because these companies are performing so strongly. Yeah. And these generation companies are the Exxons, the Chevrons, the Conocos, they're fundamentally very strong.
Do some of the acquisitions that we've heard about, some of the ones that have been proposed, some of the ones already in the works here, do they make strategic sense to you?
Yeah, absolutely, because the companies are better off consolidating, especially market multiples are higher, the bigger companies, and quite disappointing, frankly, for medium companies. So it's highly accretive for the big guys just to keep consolidating. And we're waiting, as you know, on 3 huge deals for approval from the FTC. So there's a backlog of stuff out there. Yeah, it's made perfect sense for the big guys to buy the small guys.
Paul, really appreciate your joining us today. Paul Sankey of Sankey Research with his call that oil could go to $50 a barrel by the end of 2025. Now, coming up, a bumpy road ahead for e-commerce platform Shopify. We're going to speak with an analyst about the downside risks that he sees in the near term. This is The Close on Bloomberg.
Let's get a view from the sell side with our top calls. These are the big movers on the back of analyst recommendations, and we start off with Zim Integrated Shipping, a downgrade to sell from neutral at Citi. This following a doubling in the stock price over the past 2 months and a 70% jump in spot freight rates this year. Those moves, the analyst says, are unlikely to be sustained into the second half of 2024, creating a supply and demand imbalance. Shares down 19% here on the day. Next up, let's take a look at Sprinkler. This is that AI-powered social media software management company, really disappointing investors with its revenue forecast and a change in leadership. That led to a number of downgrades and price target revisions, including a cut to neutral at Cantor Fitzgerald. The analyst there says demand is only deteriorating, making it difficult to find a near-term catalyst that would warrant owning the stock. That stock having its worst day since 2021. And finally, let's take a look at Shopify, losing its buy rating over at MoffettNathanson. While the analyst remains excited about the e-commerce platform's future, he does see a bumpy road ahead in the near to medium term. He says he expects Shopify to make unfavorable revisions to its sales and marketing intensity. Those shares relatively unchanged here on the day, and those are some of our top calls. But we do want to stick with that last one on Shopify. The analyst behind that call joins us right now, Michael Morton, with the downgrade to neutral, the price target going down to 65 from 74. And Michael, I mean, I thought Shopify was supposed to be the Amazon killer. Are we all sort of looking at this stock wrong?
No, it still serves a great purpose to internet entrepreneurs and increasingly will serve larger enterprises. But this is really an expectations mismatch in what we think is going to occur with the expenses going forward. Business still has a really exciting outlook in the future. It's going to continue to produce really impressive levels of GMV growth. But we think the merchant acquisitions, bringing on more e-commerce merchants, is just going to be increasingly expensive going forward.
So this isn't really about a top-line growth issue. This is more about what margins and profitability is going to look like going forward. Can they do anything in the interim to maybe improve those margins, or is this just kind of we have to wait it out?
They've done a couple things in the past. They divested their logistics business. They've done a reduction in force to reduce headcount. Everyone in our coverage world kind of overshot during COVID, right? They overhired. If you drew a line from where the business was at certain points, everyone was trying to keep pace with that. Now, they have done some things where they were able to bring merchants onto the platform at a more discounted price, and that did help build the base. Going forward, when you ask about can you maintain this level of growth or at the same time margins, it's a pull and push, right? If you want to let growth decelerate, you don't spend money on advertising, but if you want to keep the growth where it is, try to attract as many merchants as possible. If you think you're running away with this market, which we think Shopify is, they have the best e-commerce software in the business, they're out innovating peers. You want to gather as many merchants as you can outside of the Amazon ecosystem. It's just going to be increasingly expensive as they've brought on, I would call it the low-hanging fruit over the last several years.
So for now, we may have seen peak Shopify in terms of growth and margins, at least in the near term. Who benefits from this?
I don't think it's necessarily at this point a winner or loser game. 90% of Shopify merchants also plug their stores into other platforms, right? So you can be a Shopify seller and you sell through Amazon, you sell through other platforms. I would say the losers to this are the Salesforce and Adobe of the world, who compete with Shopify for e-commerce software. They have the best offering in town, and they're thinking very long term. This company is run by the founder. He is playing this for like a 100-year company, and he is willing to invest what is needed over the next couple years to attract that base. But investors have a very different time horizon. On the sell side, we have a different time horizon than a founder who's talking about a 100-year company. So our expectations don't always perfectly match.
More like 100 days, most of us.
Yeah. Okay. So maybe we're not looking at 100 years down the road, but at what point would you reconsider upgrading the stock again? Because you do believe in the business.
I think the ability to demonstrate merchant growth, they don't break it out specifically, but you can look at how the top line is growing, and decreasing sales and marketing intensity would be a sign that our call is incorrect. Because again, we really like the core business here, but when we look at the data that they shared with us at the Investor Day, did some kind of mosaic theory to back into what we thought is going on, we're concerned with just some of those underlying trends right now. If we're proven wrong, we still love the core business, and in our jobs, we're encouraged to change our mind when the data changes.
Right, or you lose your job. I am curious, though, too. I mean, obviously, I know you guys really look at these companies from the bottom up, but I'm sure you also have to be looking at macro conditions, economic conditions, consumer spending, if you will. How, if at all, has that been factored into your view of this company, at least in the short term?
It's really fascinating. It's one of the number one questions we get on Shopify. How are they able to grow GMV 20% when the rest of the world selling discretionary goods is growing 0, and Amazon is growing high single, low double digits, but they have a lot of non-discretionary goods. It's a really impressive aspect. It's partially because Shopify is able to add so many merchants, but their merchants are also selling discretionary goods that are really unique and attractive. So it's always something we think about, but a company of this scale in this many countries, it's just frankly hard to make that type of macro call in the near term.
Yeah, hard to make that macro call in the near term. What about Shopify's prospects overseas, not just in the United States, and where the economy has held up fairly well, better than a lot of people had anticipated?
That's part of what has gone on, we think, with the merchant acquisition that occurred in the last 2 years. Shopify lowered their prices in 200 countries and made it so it was adjusted for purchasing power. So they're doing a great job. They're growing hand over fist in Europe right now, which was traditionally thought to be a market that was difficult for them to access because there was localized e-commerce software. There was a sense of nationality, hey, I want to go with my country's e-commerce software provider. As I mentioned earlier, they're running away from the competition with innovation, and they're growing globally at an extremely impressive clip right now.
All right, Michael, thank you so much for joining us. Michael Morton over at MoffettNathanson. This idea, Romain, he makes clear that it's an expectations call more than anything else. The business itself is intact.
Yeah, the business itself is intact. And I was kind of looking, I mean, the stock is having an awful start to the year. I thought it was down like 20, 30% or something. But then you have to remember that, it had that doubling, I think, in 2023. I forgot what it did in 2022. So this was a stock already elevated in terms of valuation as well. So I don't know, maybe the short-term pullback is somewhat warranted.
Yeah, well, it does provide a re-entry for anyone who maybe did get out and is looking to, at some point, load back up once again.
So you're a glass half full kind of person then? Yeah.
Sometimes.
Sometimes. Depends on the day of the week.
Exactly. There's no consistency to that. Yeah. We, of course, are going to talk about big tech because you look at Magnificent Seven, they've diverged in a big way today.
Yeah. It's not, we can't call it the Mag 7 anymore. It's like kind of being whittled down.
The Magnificent One?
Yeah, maybe. Just call it NVIDIA.
Not today, though, because you take a look at how NVIDIA and Microsoft are performing. There's some antitrust probes against both these companies regarding their moves in artificial intelligence. We'll dig into all of that next. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Scarlett Fu. And, no one wants to get ahead of this jobs report. We knew that was going to be the case for most of this week, but it's really, things have ground to a complete halt.
Yeah, a lot of people really are waiting to see what those numbers say before we see some broad market moves. I do want to highlight, though, Scarlett, a couple of individual moves, and one that has caught my eye and everyone's eye is your favorite, GameStop, up 50% right now, all because your best friend, Roaring Kitty, Deep F Value, has planned a live YouTube stream for tomorrow, noon, New York time.
What do you think trading volumes are going to look like tomorrow at noon?
Well, the trading volumes right now are already through the roof, so my guess is they are going to be to the moon.
Yeah, and beyond. All right, well, we'll of course keep an eye on that, but you can wait 5 more minutes and maybe things will change there. But we are keeping a very close eye, of course, on big tech names because Bloomberg has learned that the FTC is investigating 2 of the world's most valuable companies. We're talking about NVIDIA and Microsoft over their dominance of AI, and that is according to people familiar with the matter. Now, earlier at the Super Return Conference in Berlin, we spoke with private equity investor Orlando Bravo about the challenges of doing deals in the AI space.
It may take 9 months to close a deal instead of 3 months. It may take a year to close a deal. But for something that adds value, you have to just look forward to that.
it may take longer than what a lot of people expect. Joining us now is Bloomberg antitrust reporter Leah Nylen and Bloomberg executive editor for technology Michael Shepard. Leah, let me start with you because you have been reporting on this. Orlando Bravo talked about how the deals may take longer to do, and when they are completed, the feds might come in and start picking them apart.
Yeah, the Justice Department and the FTC are looking very closely at AI, even before the news today that they have opened these probes into Microsoft and NVIDIA. They had been talking a lot about their concerns about AI and worries that some of the big tech companies in particular might end up sort of dominating the market in the same way that they did with the early internet and the mobile space. So they are paying particularly close attention oftentimes when they have these deals that don't necessarily follow traditional deal terms where, for example, the one with Inflection where Microsoft hired all of the company's employees and then, paid the company a little bit of money to license the technology afterwards.
Well, Leah, I'm glad you brought that up because that really does seem to be the crux of the issue. And I remember this issue being raised at that time, not just, of course, with what we saw with Inflection, but a couple other deals. And even Microsoft's investment in OpenAI, the idea was, why not just buy them outright? Everyone seemed to say that this might have been their attempt at a runaround regulations.
I don't want to characterize what Microsoft did, but the way in which it did both of those deals, it actually didn't have to tell antitrust authorities about it beforehand. And under the normal rules, they would have to tell them ahead of time and then wait. Because of the way they structured both of these transactions, they were able to just do them without notifying the antitrust authorities in advance. Now the antitrust authorities are looking at both of those deals, the OpenAI investment and the Inflection acqui-hire. Yeah. But, if they do end up doing anything, it's going to be months and months, maybe years down the road.
This gets to a question, too, Mike, about this idea of just how much bite right now antitrust regulators even have. They've already lost a couple of key cases this year. There's a lot of questions about this election and whether we end up with a whole new slate of folks in those regulatory seats here. What's the general expectation right now that this could even get done or being seen to the end?
Well, it's a great question, Romaine, because we really are at this inflection point with an election coming up and also the antitrust enforcers here in Washington really biting off so much with their agenda. It's a key part of the Biden administration's overall approach to the economy. In addition to the investments that they're making in chips and other areas, they're also trying to find ways to make the economy and industries more competitive to help keep prices down in a number of areas. We're talking about the grocery store, we're talking about airlines, and we're also talking about technology, too. And they're looking for areas where they see, certain larger players taking advantage, in the government's view, of loopholes either in the system or finding ways to leapfrog ahead of their rivals.
Right. And as you put it, this is something definitely the Biden administration is pushing very hard on, Mike. So we know that the agencies here, the FTC, the Department of Justice, they've been negotiating for 6 months over who investigates which companies. Do we have any sense of whether Microsoft or NVIDIA, the targets of these potential investigations or these investigations, were aware that these discussions were taking place and have kind of planned for it?
Microsoft definitely knew that there was something going on. They were already under investigation in the UK and the EU with relation to the OpenAI investment. So they had to have known that the Justice Department or somebody here in the U.S. was going to take a look. They, however, would probably have preferred the Justice Department to be the one moving forward. They have long had a relationship with the Justice Department since 1993 when, I guess that was the Clinton DOJ first opened the first investigation into Microsoft. And, the Justice Department has reviewed all of their mergers until this most recent one with Activision, where the FTC sued. And the Microsoft is still a little bit burned about that, even though the acquisition did close. And so they can't be very happy that now it's Lena Khan's FTC that's going to be the one looking into them.
Mike, is this going to put a chill, I guess, over other potential deals? We've been talking all year long about how, the joke that we get with a lot of guests is that when they were considering M&A deals in the past, the first person you call is your investment banker. Today, the first person you call is your lawyer and your head of regulatory affairs.
Well, Romaine, I'm glad you asked about the chill because we've already seen a few signs of this. Recently, Leah and I worked on a story together from her coverage of a conference here on antitrust in Washington. And across the street from the conference, there was an event where there were a lot of AI industry people present. And what was striking is how many of them had come previously from the enforcement ranks. So clearly the industry is bracing for impact and preparing for more scrutiny. Now, whether that scrutiny will last for political reasons or whether it will have a lot of bite or effect in the long run remains to be seen. But nonetheless, they are now aware that they are in the crosshairs of the government for sure.
All right, guys, really appreciate you taking time for both of us today. Michael Shepard and Leah Nylen, some of the best of Bloomberg here. A closer look here at the antitrust probes into the AI space. When we come back, we're going to take a closer look at the future of robo-taxis. Ed Ludlow actually had a chance to sit in one of those Amazon Zoox vehicles, and well, it's a big gamble right now that Zoox is taking in Las Vegas. We're going to catch up with Ed in just a second as to just how close the future really is. This is The Close on Bloomberg. All right, Amazon has an autonomous ride-hailing company called Zoox, and it recently expanded to a new testing route in Las Vegas. Ed Ludlow actually had a chance to ride in one of those cars alongside its co-founder and live to tell the tale.
This is still a bit of a novelty. Most people driving next to us have never seen one of these.
This is a robo-taxi from Zoox, an autonomous ride-hailing company owned by Amazon. It has no steering wheel, no pedals, and 4 inward-facing seats. It's now running on a 5-mile loop in Las Vegas, across 3-lane roads, unprotected turns, and in mixed traffic at speeds of up to 45 miles per hour.
We really want it to feel like you're being driven by a very safe, expert human driver.
A Zoox robo-taxi runs on software trained on millions of miles gathered by test vehicles. It's also packed with sensors, cameras, LiDAR, radar, and temperature probes, which generate a full picture of the world around it in real time. It's bi-directional, with a battery electric drive unit at each end.
On our left-hand side, there was cones and warnings, and we cut across 2 lanes of traffic.
The map probably didn't have those cones in it, but we have to be able to detect anything that's changed in real time and then adjust our plans accordingly.
Zoox wants to prove its tech works on the outskirts of Vegas before launching in the city as its first commercial market. Though a US agency is now looking at Zoox's self-driving tech after 2 incidents with test vehicles. One of Zoox's main competitors is Alphabet's Waymo, which uses retrofitted cars for its autonomous ride-hailing, while GM's Cruise has recently scaled back plans and testing of its own purpose-built Origin robotaxi. Zoox has been deliberately cautious about when a commercial service will launch. Expansion to San Francisco for the true robotaxi is in the works, but right now Zoox can claim to be the only operator of a purpose-built robotaxi allowed to give rides on public roads in America.
A closer look at that robo-taxi from Amazon Zoox. Ed Ludlow, the man you just heard there talking, joining us right now on set. And Ed, give us a sense here. When you were talking to the CEO there, I mean, did it give you a sense of who they are actually going to target with this product once it does get approval to really be rolled out to the public?
So it's exactly why Las Vegas is so interesting. Their thinking is that everyone that flies into Vegas, I mean, you and I know, you don't hire a car, you're not jumping on a bus, you're usually getting an Uber and a Lyft, or maybe a chauffeur to pick you up, take you to one of the hotel's casinos. And so because there's that variety of traffic, there's high temperature, which means less rain, it's a great proving ground to both test the market and test the environment. Is a launch market. And actually what I learned as part of that conversation is they're probably going to pull the trigger on public rides as a service at the end of this year, maybe beginning of next.
Okay, I don't know who you hang out with getting chauffeured rides to Vegas or from the airport to the Strip. But Ed, as we look at pictures again of this Zoox vehicle, one thing that strikes me is the windows are all tinted. And I know you were busy talking to the CEO, but can you look out the window? I mean, can you see what's ahead of you, the road ahead as the car is moving?
So you cannot, and that's by design, right? There are 4 inward-facing seats, and as we say in the piece, it's bi-directional. But by design, the headrests of the opposing seats block the window. You can see out of the side windows, they open kind of like subway cart doors or like airport monorail doors. But the thinking is that they just want this to be normalized, that you would get in if you're a commuter in any city going to work, look at your phone, not to be worried or concerned by the world around you.
Is there a sense that we talk about, you mentioned in your package there, Ed, some of the incidents that have occurred with the Zoox vehicles as well as some of its competitors' vehicles. This is going to be a big hurdle because we talk about the technology in there, and you know how this technology works. It has a lot of promise, but it also has a lot of blind spots, pun intended.
So from a technology perspective, Zoox has gone like the full 9 yards in doing redundancy. It's got camera, LiDAR, infrared, systems and radar. So if some of those systems fail, they're backed up by others. Regulators are looking at Zoox, but they're looking at some incidents that involve the retrofitted test vehicles. They have this kind of steadfast belief that the only way to convince the consumers, the regulators, the lawmakers is to have the purpose-built robo-taxi. And it's really interesting to like compare and contrast with Waymo, who have so many vehicles running around California and Arizona. Those are retrofitted cars, and what Tesla hopes to do, which we'll learn more about in August.
The real question, though, here, Ed, is did you actually have to tip anyone when you were done?
I have to be honest, full transparency, this is Bloomberg. We didn't pay for the ride. We simulated what it would be like in the app. And they're also doing this here in the Bay Area, by the way, but it's just a 1 mile stretch of road that only Zoox staff can use. So send me out on another assignment.
Okay. Well, you don't have to ask us.
Yes.
Bloomberg's Ed Ludlow, thank you so much. We're going to count you down to the close next with Lauren Goodwin of New York Life. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. With just about 10 minutes until we get to those closing bells. Coming off of yesterday's record rally, a bit of a pullback here this afternoon.
Yeah, today it's a total yawner compared to yesterday. I mean, we had $3 trillion market cap for NVIDIA. We had record highs for the S&P and the NASDAQ. And today we have not much, as everyone waits.
Everyone waits, of course, a big payrolls report coming out at 8:30 a.m. Washington time. Will that change the narrative, or are they going to still be waiting for the Fed next week or for, I don't know, start of earnings season or maybe the fall? Who knows?
Maybe. I think that the summer is going to be an interesting one for sure.
All right. A little bit earlier, we had a chance to catch up with Lisa Shalett over at Morgan Stanley Wealth Management, and we actually asked her if she thought the market rally would continue.
The path of least resistance between now and the end of the year is for the market to grind higher. I do believe that we are going to see an improvement in breadth with more sectors participating as corporate profits do improve a bit here. But at the same time, I think we have to have measured expectations.
The potential for the market to grind higher. Those were the comments out of Lisa Shalett, who helped kick us off to the close just about an hour ago. And here to help take us to the closing bells is Lauren Goodwin, economist and chief market strategist at New York Life Investments. And Lauren, we were talking with Lisa about this idea here of like how much juice is left in this market. And obviously, the answer to that really depends on where you think we are in the economic cycle and where you think corporate fundamentals are. When you look at valuations and you look at your outlook or your folks' outlook over there at New York Life for earnings growth here, do you see some justification for further gains?
I do expect that we have some room to run left in the rally, but where I would disagree with Lisa's comments is that an expectation for more broadening from here. I think we have seen the improvement in earnings growth that, frankly, has been a bit of an upside welcome surprise for many investors. That doesn't mean that earnings growth necessarily deteriorates for Q2 as we get into reporting here in the next couple of months, but it is an environment where, as economic growth now, we are seeing early signs of slowing. It's an environment where we expect income aware and earnings resilient parts of the market to perform better.
What about the economic picture of this? I mean, we talk about sort of waiting on the Fed next week, waiting on a big jobs report tomorrow morning here. We've already gotten a lot of data points that seem to suggest there is softness out there. Now, is it the good softness that we should be celebrating because it's going to tamp down inflation, or is it the bad softness and we should be scared that maybe the economy is headed towards something bad?
The first is almost always a path to the second. And so one thing that I will say is that bad news just really hasn't been very bad yet. And so softening in the labor market until we see outright layoffs pick up in earnest, which is not where I believe we'll be tomorrow or even in the next couple of months, until we see that, the market has room to run. It's historically that moment that layoffs pick up meaningfully and that earnings growth decelerate that we start to see the equity market react to already being in recession.
So Goldman's tactical specialist sees a flood of cash coming into the markets in early July. It'll be a new quarter, a new half year, and that money will need to be put to work. Whether or not you agree with that, Lisa Shalett disagreed with that. If money does come in, where's it most likely to go to? Where is it going to gravitate to?
Well, I agree with what Lisa said with respect that the path of least resistance is for the equity market on aggregate to grind higher. But we are seeing investors already concerned about valuations. Now, that's not necessarily a sign that anything bad will happen to valuations. It's not a very good market timing indicator. But where we prefer to take incremental risk is to diversify both in equity, inching in more and more into international markets, as well as into infrastructure, both as a thematic and levered play, but also to activate equity risk in fixed income. One of our highest conviction views for the next few months is that with, regardless of the exact timing, global central banks, including the Fed, beginning to cut rates, it's an interesting time to capture higher rates, higher yields, and also take that equity-like risk in fixed income where the carry is more attractive.
And that would be in high yield, or is there certain sectors that you're looking at more carefully than others, or is this a very much bottoms-up kind of exercise?
It's a bottoms-up exercise looking at quality within asset classes as opposed to quality among asset classes, which is what investors tend to do late cycle when they see early signs of weakness. However, really where we have highest conviction is not only in the health of the high yield market relative to past cycles, but also conviction that moving out of cash and into short duration securities in this cycle makes sense. So that's not only short duration high yield, but to give a couple of other examples, municipal bonds and investment grade credit as well.
I sort of chuckle when you say short duration equities. Because, I feel like the trade for so much of this year has been NVIDIA, which is kind of getting to the point where it's like the longest of longest durations. You guys just put out your sort of megatrends report on AI in this space here. Do you see real fundamental support for the business model, at least as we know it today, to really provide some justification for the valuations that NVIDIA and some of these other stocks are at right now?
We do. Where the real oomph behind the tech and artificial intelligence trade so far has been is in this foundational layer of data, of chips, algorithms, structures. It's so important, and the barriers to entry in that space are high. So that doesn't mean that there can't be competitors. I believe there absolutely will be. But just the sheer amount of investment to get into the space and then the demand from all of the other corporate users of artificial intelligence, we believe justifies the story. But when it comes to that balance between that justification and reward, where we see the most conviction in the artificial intelligence trade from here is in the run up to scale in AI. So thinking more about powering AI, starting to think about how corporate applications get made, because it's a lot of fun to think about all the different ways that AI can make us all more productive. But the reality is that we aren't using those tools yet. And so that run up to scale we see as the key opportunity.
Right. And it's the long-term growth story that everyone's excited about. In the near term, we've got the Fed next week. And we know that there's not going to be any change probably next week. But how are you gaming out what happens for the rest of the year?
When it comes to central bank policy, I believe that while we've seen a lot of Fed speak in the last couple of weeks, a lot of focus on everyone's first sentence, which is inflation doesn't yet give us justification to cut, which it doesn't. The data just isn't there. A lot of us have been ignoring the second part of that sentence, which is unless we see further weakness in the labor market. And while I mentioned that I'm not expecting layoffs to pick up in earnest just yet, I do think that's coming in the second half of the year. And as we see labor market normalization, wage stabilization, that takes off the table, or at least removes a major source of risk, the biggest risk to the market in my view, which is that threat of overheating. And so as we've moved past that overheating conversation a bit, I believe that conversation expectations around the Fed cutting in July or September will start to reemerge.
All right, Lauren, got to leave it there. Lauren Goodwin of New York Life Investments helping us count down to the close here, coming off that record rally that we had on yesterday here with the S&P and NASDAQ. A bit of a pullback here on this day, despite the fact that you got some big names really getting the bid, including Amazon, Tesla, and Alphabet.
Yeah, but it's all eyes on the jobs report tomorrow and, of course, the FOMC on Wednesday.
We are moving closer to those closing bells. We're going to have a full breakdown of all the market action, so don't go anywhere. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Tim Stenovic, and I believe, if I squint very hard, I have a Carol Masser
I was working yesterday. Don't get used to this.
I wasn't here, but I was working yesterday.
She's not here tomorrow.
She's not here tomorrow. Okay. All right. Well, let's welcome all of our viewers across our Bloomberg platforms, because this is the last time you're going to see Carol Masser this week. On a day where, Carol, you missed a huge rally yesterday, a record rally, NVIDIA topping $3 trillion.
I know.
A bit of a pullback, though, today.
Yeah, I feel like it's kind of limping towards the jobs report tomorrow, and maybe even kind of limping. I do think we're focusing and thinking a lot about what the Fed's going to do next week. After the ECB cut rates as expected, guys, but talked about higher inflation. Still trying to get our head around that one to some extent, but I do think we're just kind of counting down to next week.
And tomorrow,
which is why I can take
like
off
you
Friday.
said, 180,000 is the jobs expected to be added, according to economists surveyed by Bloomberg. Last month, it was 175,000. We'll see what the revisions say. We'll see what the number comes in at. But there are concerns that it could come in a little soft.
And let's not forget, after the jobs report at 8:30 a.m., you've got Roaring Kitty hosting.
Oh, my God. See?
I thought we were talking fundamentals
From
here,
the serious to the
For some people,
craziness.
this is fundamentals. At noon, he's going to be hosting a live, webinar, and he's going to talk through, I guess, his fundamentals for GameStop and all those other
rundowns.
stocks.
We've got our new top story.
All right. Well, those shares up about 50% now. In fact, that's one of the few bright spots out there, at least in terms of the big movers. I do think it's interesting, though, to see the pullback today in NVIDIA and Apple, which, of course, have been leading the rally over the last few days. I guess understandable given some of the big gains. Even the kids are loving it today. I guess if you're into the Dow Jones Industrial Average, a gain on the day of about 0.2%, and that is your one bright spot on the day. The S&P 500 lower only by about 1 point. So we'll just basically call it unchanged on the day, 53.53 as we wait for these numbers to settle. The NASDAQ composite is going to finish lower by about 15 points or 0.1%. The Russell 2000, though, that was a more definitive move to the downside, lower by 14 points or about 0.7%.
All right, small caps, as you, I think, pointed out, or did you point out?
I'm sure I did.
Oh, okay, you did. Sorry, I was kind of listening, but I was also looking at some other stuff. All right, so let's go to the S&P 500.
Story of my life.
I appreciate your honesty, Carol.
You and our wife are collaborating. It's kind of an even split. 202 names in the S&P 500 to the upside, gaining ground. 299, almost 300, Scarlett, to the downside, 2 unchanged.
All right, let's take a look at the IMAP and how the the industry groups within the index performed. Pretty much a mixed picture. Consumer discretionary, that includes your home builders, your automakers, and your retailers, gaining about 1%. Energy also higher, with oil prices and consumer staples gaining a third of 1%. The weak links, utilities, industrials, and for change, technology.
All right. Wow. Yeah. Interesting. All right. So let's get to Scarlett. You really laid it out. I'm just going to remind everybody, GameStop, be there or be square tomorrow, and we'll see what is going on. But nonetheless, really an outperformer in today's session, up almost 50% at its highs, finishing the day just shy of a 47% gain. So we'll be looking to see what Keith Gill, Roaring Kitty, what he has to say, what he's doing in terms of his position. So kind of fascinating, to say the least. Lululemon, though, guys, up almost 10% at its highs today. Finishing the day with about a 4.8% gain. This was among your biggest gainers in both the S&P 500 and the NASDAQ 100. Company boosting its earnings per share guidance for the year and reported first quarter profit that topped expectations, and it raised its stock buyback plan by $1 billion. So that certainly... What?
No. The one thing I want to mention, excitement over leggings that use hydrogen yarn.
I'm sorry, I missed that.
I don't
What
get
is that?
I don't know.
Is it hydrogen water?
It's going to cost at least $100, I'm sure.
Okay, of course, and never go on sale. We've all been there.
Yep.
Illumina, also an outperformer today, folks, up about 7.5%. Another one of a top gainer in the S&P 500, NASDAQ 100. Analysts have been weighing in on the news that the company is anticipated to spin off Grail from the company on June 24th, have it listed on the NASDAQ. You might remember European and U.S. regulators opposed the reacquisition of this company, which Illumina founded. Grail has a blood test to detect about 50 types of early stages of cancer. So you've analysts kind of weighing in on that. One more, J.M. Smucker, because I like to say it, up about 4.6%. The company's annual guidance, better than feared. At least that's what investors saw. The company sees 2025 adjusted EPS $9.80 to $10.20 a share. The estimate on the street is $10.18. But again, an outperformer in today's session.
Okay, you got the outperformers. I got the underperformers. I do want to start with Vistra Corp, finishing the day down by 6.24%. We did see I was going to say outages, but they weren't outages. We saw declines across power and electrical equipment companies today. They extended a pullback even as investors bet that the firms will benefit from demand for power fueled by AI and data centers. One of those firms that fell was Vistra Corp, the worst performer on a percentage basis in the S&P 500 today. It was down as much as 9.8%. It did finish off its lows. The stock's still down, though, more than 18% from last week's record close. And shares of Hertz Global Holdings, the parent company of Hertz, falling today after Bloomberg reported that, citing people with knowledge of the matter, that the company is considering the sale of at least $700 million in securitized debt, as secured debt, as well as convertible notes. This an effort to bolster its balance sheet after that EV blunder over the last few years. The company's advisors have begun contacting potential investors regarding the secured debt issue. Some of the people said, we should note that no final decisions have been made, and the size and other terms of any financing could change. And then, Romaine, worth checking in on shares of NVIDIA a day after the company hit $3 trillion in market cap. There was a bit of news that the U.S. is opening an antitrust investigation into NVIDIA and Microsoft over their dominance of AI. That's according to people familiar with the matter. NVIDIA shares only fell by 1% today. Doesn't seem like investors really were concerned about this.
Yeah, I mean, now they're down at about a $2.977 trillion market cap. Though we should point out that actually now bumps it back below Apple as a sort of the neck-and-neck horse race between those two companies for our market cap dominance continues. Meanwhile, we go back to the yield space here. We did actually see a reversal from what we had seen the previous 4 days. Yields slightly higher, and I do mean slightly. We're basically barely talking about a basis point here. So honestly, you could just call that unchanged, and I think that gets to this idea here of this holding pattern that I think the markets overall are kind of in. They really want a closer peek here at that monthly U.S. jobs report that we're going to get 8:30 a.m. Tomorrow morning, Carol. And not just for the read on jobs, but really that read here on inflation as well, where it's going, and whether we're all just kind of sick of talking about it.
Yeah, absolutely, right? There's so many different pieces, wages, and, you know, we want to get an idea of what it all means. I was drawn to a story on the Bloomberg Terminal from our economics team, or Eliza Winger putting it out, and they have basically a high-frequency dashboard. They look at a lot of different metrics. Their bottom line on this is that they expect economic momentum to slow in the second half of the year, and they are pointing to different factors, whether it was in the Beige Book and some other sentiment readings, that basically consumers at this point, they're feeling a little bit of a price fatigue. And so maybe pushing back on some of these higher prices, and that ultimately could lead to limitations in terms of what we see with growth here in the United States.
Okay, so here's some of that alternative data. Job postings on Indeed are down 32% from their late 2021 peak. At the current rate of decline, Scarlett, postings will reach their pre-pandemic level by the end of August. So maybe some normalization is happening here.
And of course, everyone's lived experience, right? Spotify prices are going up. My HBO Max is going up. I'm going to have to drop my gym membership because each month they're charging $10 more. And, you know,
well, at what point?
At some point, you just have to get rid of a lot of these things.
You do, but at some point, these companies have to stop making those moves higher, Romaine, because people like Scarlett will stop paying for these.
Well, and it's not just Scarlett. You could put me in that camp as well.
Yeah,
here.
me too.
I'm starting to sort of boycott some things now. I'm just like, you want how much for what?
So we should all go in on a streaming subscription together, I guess.
Yes, absolutely.
Say,
Bloomberg Plus. How about that? We'll all chip in for that. I was curious, though, too. I mean, just on this point about fatigue, too. I mean, there was a story a little bit earlier about Five Below, which ostensibly is kind of a discount retailer. It's kind of a dollar store on steroids. But they're not even performing well, as apparently like people are, I guess, over it. I'm not just confused. So are we just not spending on anything?
Well,
We're spending on Lululemon leggings.
We know Carol is. Carol's been on vacation, so we know she's spending a lot. But for the rest of us who are here working.
I'm not.
No, she was working.
I got a kid in college.
My condolences.
Exactly. But they talk about it, demand for what is it I didn't know about. Did you guys know about Squishmallows?
I don't know what they are.
What are those?
That was the big gift last Christmas.
All
What
right.
are they?
These stuffed
For less
animals.
than $5?
Yeah, I don't know, but apparently demand has fallen for them, and so consumers are shifting to things like, go figure, like food and some other important things.
Food.
So sorry, you can't do the Squishmallows, but you do think about these like little luxuries, and that maybe you're not spending on them. What does that say though about?
Can you play with food? You can play with the Squishmallow.
Don't play with your
little
food.
luxuries are the services that you pay for right now. That's a little luxury, right?
So
just holding on to it.
Romain's giving up the gym and Netflix, but he's not giving up Squishmallows. Is that what's going on here?
I mean, a man needs something.
They're below $5.
A man needs a hobby. Girl. I'm just a simple man. What can I tell you?
Oh, no, not simple. Not simple. All right, guys, that's a wrap. And we got to work on making sure that Scarlett gets to keep that gym membership.
See you in a couple weeks. Okay.
All right.
She'll be back Monday.
Oh, man. That does it for the cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. I'll see you Monday. The rest of the team, sorry, they'll see you tomorrow.
All right, stick with us. A lot more coming up here on Bloomberg Television. A closer look ahead to that big jobs report. This is The Close on Bloomberg. Welcome back to The Close. Romain Bostic here with a closer look at the big market moves here on this Thursday afternoon. An S&P 500 and a NASDAQ coming off record highs yesterday. A bit of a pullback today. You can call that unchanged with the S&P still camped out right around that 53 level. But again, you see big tech dragged down today by Amazon, by Tesla, and a few other big names. Even Nvidia moving lower here by about 1% on the day. Your 10-year yield unchanged ahead of that big jobs report. And an interesting pullback in Ether. Keep an eye there as some of the bloom coming off the rose of the optimism surrounding an Ether ETF. As far as some of the individual movers, you did see that 1% decline in Nvidia today, but you saw a bigger pullback in a lot of the power companies, including Vistra, down about 6%. Remember, these stocks have been big beneficiaries from the AI optimism. Maybe valuations got a little bit too far afield. Robinhood also higher here on the day, but one of the big winners was GameStop, a 47% run up here on the day, ahead of what is going to be potentially a momentous day for Roaring Kitty Deep Value, who has scheduled a YouTube live stream at 12 p.m. New York time on Friday. But our top story today in this hour is about a big story for tomorrow, the macro and that monthly U.S. payrolls report set to be released in less than 24 hours. Now, the drumbeat to that report has already shown us ADP private payrolls data, the JOLTS job opening figures, and the weekly jobless claims, each of which suggests softening labor market conditions. But what may prove even more critical to perceptions of the jobs picture is data that was published on Wednesday by the government that suggests payroll reports from last year will actually need to be revised downward. That data showed jobs growth was about 60,000 less per month on average than the 250,000 run rate on the books. If such a massive revision is indeed made, it means the Fed's current calculus on whether it's appropriate to cut rates might actually be wrong. And the bank risks coming late to the rate cut party, particularly now that two major central banks this week in Canada and in Europe kicked off their easing cycles. For more insight on tomorrow's U.S. jobs report, let's bring into the conversation Yelena Shulyatyeva. She's the senior U.S. economist over at BNP Paribas. All right, Yelena, I do want to start off here with the numbers that we are going to get tomorrow here, at least based on Bloomberg's estimates of what economists expect. We're looking at about 180,000 on that top line number here. Does that sort of in your same wheelhouse as to what you're forecasting there over at BNP?
Yeah, we are expecting 200,000, just slightly above consensus. And the overall picture is of a rebalancing rather than deterioration, I would say. So that is a welcome rebalancing that the Fed is looking to see. And that's really the story. So in terms of rebalancing, I mean, like we are slowing down to a more sustainable pace of growth in payrolls. But at the same time, we may see a rebound from a weaker than expected April number. So there was a big swing between March and April in terms of jobs. So that could have be a result of the earlier timing of the Easter holiday. And the government is trying to adjust for these numbers, seasonally adjust these numbers, but it may not be always perfect. So we may see a little bit of a bounce back from weaker April. But the labor market is slowing, indeed.
Yeah. But is slowing in a good way, Yelena? Because there's slowing in a good way where it aids the inflation process, and then there's slowing in a bad way where we have to start talking about an economic decline.
Right. We are more in the good slowing camp here. So one thing that I would like to point out, and that's a risk going forward, is JOLTS data that you mentioned that was released earlier this week. So we saw quite a sharp decline in vacancy rate, so that it fell below 5%. And when it falls below 5%, that usually means that we may see some more significant increases in the unemployment rate. So I don't think that we will see it tomorrow, but going forward in a few months or so, we may see some creeping higher in terms of the unemployment rate. Here, what's very important to see is the speed at which the unemployment rate rises. So I don't think people have any doubts that the unemployment rate is going to rise, but the speed at which it's going to rise. If it rises very rapidly, it could trigger the SAM rule, which is not a good thing, obviously. But if it rises only gradually, as we expect something like 4.1% by the end of the year, then it's going to be just fine and something the Fed would actually appreciate.
This gets to the idea, Yelena, and it goes back to sort of all the talk about these payroll revisions. And I know these revisions are routine. We get this all the time. But the difference does seem pretty dramatic, taking 60,000 out of 250. And it gets to the question of, is the data that the Fed has been talking about, the data that they're so dependent on, has it been reliable?
Well, the data is prone to revisions. That's the one of the things that we have to deal with. I think there is some merit to expect some downward revision in payrolls based on what we have seen on this from this preliminary data. The key word here is preliminary. In August, what we are going to get a preliminary estimate of a benchmark revision. So the preliminary data could be revised when we get the final estimate in the beginning of next year. And it's very difficult to predict the numbers, but it's even more difficult to predict revisions. So what I'm saying is that even the data that you referenced, the quarterly census of employment and wages, that data itself is prone to revisions as well. So it's very uncertain what the magnitude of a revision we will see, if we see any. So I think there is a merit to that, to see a slightly lower pace of payrolls. I don't think it's going to move the Fed. And the Fed have seen those numbers already back in March, and they were still happy with ongoing rebalancing in the labor market.
So based on what we know, at least publicly, Yelena, you don't have any real sense here that the Fed would have an argument to start an easing cycle anytime soon?
Not based on this data. And if we continue to see gradual rebalancing in the labor market, the Fed will be happy to wait a little bit longer to start the cutting cycle to make sure that inflation is on the right path.
Does it matter that the ECB, the Bank of Canada, have already started their easing cycles?
Not really. If it's followed pretty quickly by a cut from the Fed, and we expect one in December, the economy may be ready for for the start of cutting in September, but we don't think that the Fed will reach a conclusion at that time. At that time, it will be very uncertain what the outlook for 2025 is. Right? So you have all these different scenarios for the economy. But we don't even know, like, if the Fed is going to have to cut or hike at that point. You know, there are some scenarios under which you will see a very inflationary outlook, and the Fed will just basically have to react to that.
All right, Yelena, always great to talk to you. Yelena Shulyatyeva, senior U.S. economist over at BNP Paribas. A closer look here up ahead of that big jobs report coming out at 8:30 a.m. Washington time. And in the backdrop of that jobs report, there's a lot of anecdotal evidence that the labor market is tighter. A lot of job seekers saying they're getting some bizarre questions on applications and job interviews that maybe suggest that the balance of power has shifted back to the employers. Bloomberg's Jo Constant joining us right now. She's been writing about this, and I thought some of the anecdotes were pretty funny. I mean, you actually led off with a great one about how a job seeker got invited to a bar, which I guess they thought was just going to be like a one-on-one interview, and they found out the whole bar was just full of people all applying for the same job.
Yes. So this job seeker that I talked to, she went through hours and hours of interviews with this company, and she created this whole deck and did this whole presentation. And she was so excited. She'd been looking for a job for 4 months after being laid off. She's in tech. And so she was so excited, and they invited her to this happy hour. She thought she'd be meeting, these potential future coworkers. And it was full of, as you said, other applicants for the same job. And it just, she told me it felt like an episode of The Bachelor.
And the other anecdotes also seem to be the questions that are being asked on applications, which confuse a lot of people. Certain jobs, of course, require tests to make sure that you have the skill set. But people are saying that these tests are just so esoteric, like they don't even know how to even approach the question.
Exactly. Yes. So a lot of companies now are asking applicants to fill out personality tests, skills assessments, and sometimes, the questions are confusing, and applicants are saying, I don't really even know what you're trying to ask me here. What are you trying to gauge? They're very unclear, and so that just kind of adds this whole layer of disorientation to the whole process.
Yeah, this sounds like less like applying for a job and more like dating.
Exactly.
I am curious, though, what has the reaction been by those job seekers? Have they just sort of accepted that this is what I have to do to get the job, or have they leaned out and basically just said, no, I'm just going to try to find something else?
I mean, I think most of these people, especially if you're in tech and you've been laid off, you got to do what you got to do, and you keep applying, and you try to connect with other people on social media. That's what a lot of these people are doing, to try to, find some solidarity with other people going through the same thing. And, I think networking is the key right now.
Well, but how does that work, though, too? I mean, in the same story, you talk about how talent teams at some of these companies have gone down. Yes. I mean, there are fewer people to talk to. Yes. We've talked a lot on this show here about how so much of the application process now is kind of automated. You have algorithms and things sort of weeding people out. So before you ever get to a human, you've already had sort of, been vetted by the computers for better or worse.
Absolutely. Yeah. I know. I was just talking to a college student who was saying that they were applying for dozens and dozens of internships. Couldn't even get an internship. And every time they were asked to do these one-way video interviews. And so it was very alienating, never really getting to, that person. But, you just have to reach out on LinkedIn and find people who work at the company, ask them to coffee, and keep at it.
This sounds so simple there.
Yeah, I know.
I mean, so where does this end? Because is there a link that you can make to, I guess, a loosening up of the labor market? Because a couple of years ago, the conversation we would have been having about the labor market would have been almost the complete opposite.
Absolutely.
Companies were just taking anybody with the pulse.
Yes.
Yeah.
Yes. I think that's kind of part of what is contributing to a lot of job seekers' feelings of disorientation is this feeling of it was so different 2 years ago. And so it's kind of a rude awakening now to really have things be a lot tougher, honestly, in a lot of ways, and require a lot more effort to kind of get, land a job where it may have been, fairly simple.
Yeah. All right, Jo, great stuff. Jo Constance there. She has a great story on the Bloomberg terminal from a few days ago. Job seekers facing surreal hiring tests in a tight labor market. That story coming out ahead of a big monthly U.S. jobs report tomorrow morning. All right, coming up here on The Close, stick around. Our top three is up next, where we focus in on the top three movers and shakers at the center of today's biggest stories. That's next on The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
Which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
All right, it's time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's stories. And we start off today with Kathryn Wylde, saying ARK Investment Management is well positioned in artificial intelligence assets. That's even after her company trimmed back on NVIDIA shares before the big rally last year. Speaking at the Greenwich Economic Forum in Hong Kong, Wylde said her private fund has a lot of exposure to up-and-comers in the AI space. The next person we're taking a look at is Ola Kaliunas, the Mercedes CEO, saying consumer optimism has not yet come back in China, and that even the entrepreneurs that drive those high-class cars, they've been a lot more cautious in spending. A closer look here at the Chinese economy that, at least for one man, still seems to be on the back foot. And number three is Jack Sweeney. You may not know that name, but you certainly heard of him. He's the Florida college student that has faced scrutiny for posting the paths of jets carrying the likes of Elon Musk and Taylor Swift. Now, under a new law, the FAA here in the U.S. would create a process to let private jets remove identities from public view upon request. Sweeney, though he says that's only making him want to double down. All right, when we come back after the break, we're going to take a look at the NBA. Game 1 of the NBA Finals is tonight, and we take a look back in history at the birth of the league 68 years ago. All right, Bloomberg's Market Forum FX in Focus taking place right now here at our world headquarters in New York. My co-host Scarlett Fu currently in conversation right now with CFTC Commissioner Pham. Let's take a listen.
At the CFTC, and the CFTC has this huge mandate under Title VII to regulate the OTC derivatives market, and so I just went for it. In law school, it was really, I just felt like Goldilocks. I wanted to trial the different agencies and sort of understand the breadth of the different aspects of the financial system, because I had studied actually Dodd-Frank and worked on it when I was in law school. I had a professor that was involved in doing white papers with the American Bar Association.
Did you seek that out, or was that kind of, it fell in your lap? It was a happy coincidence? Focusing on financial regulation and focusing on Dodd-Frank and all of that.
Yeah, so it started with the cases that I did for my judge with the savings and loan crisis. I had actually seen some of the run-up to the stresses that led to the financial crisis when I was at Sullivan & Cromwell, because of course they were working on many of these very big deals, Bear Stearns, Washington Mutual, I think all of them. So I actually remember being in Washington because I transferred from the LA office to the DC office to work full-time and go to law school at night, actually, is how I started off at law school. And they asked me if I could come in on a weekend. I said, sure. And it was the weekend that I think Washington Mutual had their board meeting to agree to sell the assets to JP Morgan. So really, again, just being right there in a moment in history. I liked it. I thought it was interesting. I wanted to give back. And that's what got me interested in financial regulation. And then I started trying all the different ones. And this one was too big, and this one was too small. And then the CFTC was just right. It was the
Which one was too big?
The SEC.
The SEC was too big.
The OCC was too small.
Okay.
The CFTC was just right. I'm very proud to be back at the agency for the fourth time, actually, because after interning for Commissioner Amalia, I graduated law school, of course. I then stayed home and had my daughter and was a visiting fellow, part-time visiting fellow at a think tank that GW Law has. And it is, I think, getting more and more unusual for women to stay home, and then it's challenging to return and go back to the workforce. And so that's actually when I interviewed with the Fed, because when my daughter was about 20 months old, I wanted to go back to work. And I interviewed with the board of governors of the Federal Reserve System's legal department in DC. But Commissioner Amalia had a spot for me to come back to his team. And so I went back there. And then when his term was over, that's when I got the job at Citigroup to start a new team in compliance focused on Dodd-Frank implementation and global regulatory reform. And then I moved to New York.
Okay, so there's a very consistent thread there, but going back to your time when you were trying out the different agencies, one thing I noticed in your bio is that you worked in enforcement across these different agencies. How intentional was that?
So enforcement is, for the SEC and CFTC, we are enforcement agencies. Most of the work is enforcement. Even now as a commissioner, probably 80% of my time is enforcement actions. So it's a numbers game. That's where a lot of the internships are. But again, I was in the Army ROTC. I wanted to be a CIA agent. Clearly I'm very interested in like justice and fairness and law and order. I did actually also have an internship offer that I accepted to be at the Department of Homeland Security that same summer that I had the judicial externship. But it took too long for the federal government to process my background check that by the time they said, okay, now you can start, I'm like, well, summer's over. I have to go back to class full time.
The wheels of government move slowly sometimes.
That's right.
One person who is influential in your career is Philip McBride Johnson. How many of you have heard of his name?
Oh, come
okay,
on,
I see one hand raised. He taught a derivatives class at your law school, right? He served as chairman of the CFTC, and he helped set clear boundaries between the SEC and the CFTC and their jurisdictions. Can you tell us a little bit about your interaction with him and how that put you on the path to choose the CFTC at the end of the day?
So I think it was coincidental that I just happened to be taking regulation of derivatives the same semester that I had the internship at the CFTC. And so, of course, I told my professor that I was interning at the CFTC. One of the things that was amazing to have a professor, and this is one of the things I think that's very unique about going to law school in Washington, is you do get these luminaries, these policymakers who teach your classes. And he would tell all of these stories about sort of how the CFTC was created. You know, the CFTC, the roots of the CFTC go back to the late 1800s, early 1900s, but up until the CFTC was created as an independent commission in 1974, Congress passed the CFTC Act of 1974. We actually were part of the Department of Agriculture, and I believe we were in the basement of the Department of Agriculture. So, you know, it goes to show how the agency's progressed since then. So that was an incredible experience to just sort of understand the genesis of the derivatives markets, having started with agricultural futures in Chicago and so on and so forth. One of the things I remember him teaching us was...
And you're listening there to CFTC Commissioner Caroline Pham, who was talking in a personal capacity with our very own Scarlett Fu upstairs right now at the Bloomberg Markets FX In Focus event. You can continue to listen to that conversation. Just type Live Go onto your Bloomberg terminal. All right, we want to take a day this time right now to take a look back at this day in history. June 6, 1946. The professional sports league that would become the National Basketball Association was founded. Initially called the Basketball Association of America, the league was organized by the owners of ice hockey arenas in the U.S. Midwest and Northeast. They were looking for new streams of revenue. The initial league had 11 teams, including the Boston Celtics, the Providence Steamrollers, and the Pittsburgh Ironmen. The first season, it officially tipped off on November of that year, with the Toronto Huskies falling to the New York Knickerbockers 68-66 in front of roughly 7,000 spectators at the Maple Leaf Gardens up there in Canada. Now, the initial season was far from a success, and there were several other professional leagues around at the time vying for attendance, though most were small regional operations. The BAA started to bring in some teams from those competing leagues, including franchises in Syracuse, New York, Sheboygan, Wisconsin, and Waterloo, Iowa. And by 1949, it changed its name to the National Basketball Association, with 17 franchises under its umbrella. Now, the size and complexion of the NBA would ebb and flow over the next decade, as would the league's popularity, before finally finding a groove in the 1960s on the back of future superstars like Bob Cousy, Wilt Chamberlain, and Kareem Abdul-Jabbar. In 1976, the league merged with the American Basketball Association, and the modern-day NBA as we know it today took shape. Growing from a hodgepodge of regional teams 68 years ago to an international powerhouse that now boasts more than $10 billion in annual revenue, and that revenue is about to get bigger. The Wall Street Journal reporting this week that the league is on track for a new media rights deal with NBC, ESPN, and Amazon that would bring in about $76 billion in media revenue over the next 11 years. Now, many current and former NBA players dabble in different ventures ranging from fashion, media, and even wine. Scarlett Fu and I sat down a little bit earlier with 10-time NBA All-Star Carmelo Anthony and his business partner, Asani Swan, to discuss the launch of their premium wine and why they felt now was a good time to get into the business.
Like, I just wanted to learn about the industry. I wanted to learn about what it takes to actually grow wine and what happens in the process. So I just started drinking the wine. And then I realized, look, I need to stop spending so much money on consuming this wine and figure out what is the right business model in this industry. So it took me a little bit of time to kind of figure the industry out and see where I wanted to open the door at.
Well, you partnered with Asani, and just looking at sort of the pedigree of this wine, I mean, this is like serious, like old world winemaking you're doing. You just didn't slap his name on a label and just try to sell it here. Just kind of explain exactly the region where these grapes are coming from and exactly the process that it went through.
Yes, great question. So I think a lot of people from within the Seventh Estate were a little shocked that we decided to partner with Robert Mondavi Winery. But ultimately, we wanted to produce a premium quality wine. And so we thought, what better way to do that than with one of the best and most traditional wine companies in the world. And so we had the opportunity to partner with them and then get our grapes from the Tokelau region. The Tokelau region has a great deal of soil, dried soil, and the way that the sun hits those grapes is able to develop what we get to taste in the bottle. And so that is one of the reasons why the price point is what it is, but also the process that we go through in creating what's in the bottle is so specific, and it's so specific to who we are as winemakers as well. And having the opportunity to have the guidance of Genevieve, who's the chief winemaker at Robert Mondavi Winery, was certainly an experience in and of itself to learn from one of the masters in the space.
I think everyone's curious, Carmelo, to understand your level of involvement. Did you choose the blend? Are you a lead taster here?
I am a lead taster.
Did you zero in on that pricing of, $275 a bottle?
So the pricing was out of my jurisdiction. I'm more of the, bring my palate, bring my smell, bring my innovation, to the room, whereas I just utilize the Tokelau, it is what it is. That portion of Napa, that vineyard is spectacular. So the reason I could just come in and just flow and just, because it's already there, right? And having somebody like Genevieve alongside us who's on the ground every single day, understanding what that soil is, what that region is. For me, I could just bring my innovation into the industry. So yes, I'm heavily involved from the beginning all the way to the end, where we also had a disagreement about 1% of Petit Verdot that we actually put in the wine. So
who won? Did you win?
We all won. I say we all won. We all won. It's a great wine.
Well done, well done. You mentioned, of course, that you were drinking wine and you thought, you know what, I have to stop spending money on this. But I'm curious about your time in New York and how that contributed to your education as a wine connoisseur. What was it about being in New York and and having access to all this great wine that really deepened your passion for fine wine?
Well, I think you hit it right on the word, which was access. Right out in New York, I had access to people and collectors and people that was drinking these crazy wines and these wine clubs. So I had access to all of those people. So I always wanted to know, okay, if I can get into this circle, if I can appease to this circle, if I can bring wine to the dinner and I can make this, specific circle be like, this guy know what he's talking about. He's for real. Then I felt like I've proven myself. So it was just taking my time here in New York. And I will say New York actually helped me kind of broaden my horizon to think globally as far as the wine industry and the wine business goes.
Sonny, talk a little bit about the marketing of this wine. Just a minute ago, we referenced the price point, and it is a higher price point. This is a premium product.
Yes.
How did you arrive that this was where it was going to be?
Well, I think the wonderful thing about our relationship with Constellation Brands and Robert Mondavi Winery specifically is that we were both bringing something very unique to the table. We have this innovation of tradition with Robert Mondavi Winery, and we have this creativity and Mello and I having ability to reach people in a different way. I definitely will say that we have some of the most exciting experiences when it comes to releasing our wine. For sure, we have a good time. That's part of the wine drinking experience, is what is the experience that we are bringing to the table. So for us, we really have leaned into the idea that when you drink our wine, we want it to be an experience, not just to taste it for the sake of having a glass, but what happens. And so for us, even in the naming of our wine, that was very important, ode to soul.
But I want to talk a little bit about the community that you came from, which is the NBA community.
Yes.
You talk about how wine is truly a part of the NBA culture. What does that look like now? Can you give me an example of what that looks like now versus when you first started in the NBA?
Yeah, I can't tell you what it looks like today because I'm not in it, but I will say, just years ago, right, you didn't see it. You didn't see it. You was laughed at for drinking wine, and especially as a 19, 20, 21, 22-year-old, you're not drinking wine, right? So you were kind of frowned upon, like, what you doing, man? You drinking wine? Why you drinking that? But then as you start going and the industry starts to change and it's more opportunities and more access and more resources, now people want to, they want to explore. So now you see the NBA, where players now in the NBA feel comfortable enough to say, I have to have a glass of wine, or before I go to bed at night after a game, I drink a glass of wine. These are the individual experiences that NBA players are actually having, that now the top of that is kind of off, and now everybody is hearing about it. But before, it was always inclusive. It was always inside the NBA, and we always wanted to keep that to ourselves because we always felt like people would judge us, people would say things about us, oh, you're not playing well because you're drinking wine. So we kind of told the line, but now that lid is off of that.
Yeah. You have any friendly competition with some of the other players? I mean, D Wade's got his own wine label, a few others. Do you just call them up and be like, yo, yours ain't $275?
We don't have those type of conversations, but it's more so like, how could we create the experience? Like you have yours, you have yours, you have yours. How could we create an experience where everybody is a part of this community and engaging, and you get to sell your wine, I sell my wine, we get to taste wine, and we get to have a good time.
NBA All-Star Carmelo Anthony there alongside his business partner Asani Swan. They're the co-founders of Vin, the Seventh Estate, a new wine venture here that continues to roll out. Meanwhile, here on this Thursday afternoon, as we start to wrap things up here on The Close, a look back here at how the markets ended, unchanged on the S&P 500, and that was the story for most of the major indices, though you did see a bit of a pullback today in some of the small cap names, with the Russell down 0.7%, stasis on that 10-year yield, a pullback in Nvidia, and a big pop in GameStop, and that is foreshadowing some big events on the docket in the next 24 hours. Stick with us. A lot more coming up here on The Close. This is Bloomberg. It's time now for our Muni moment, and we want to focus today on the economy of New York City. This following this week's decision by the governor of New York, Kathy Hochul, to delay congestion pricing in this city. Joining us now is Kathryn Wylde. She's the president and CEO of the Partnership for New York City. And Kathryn, I don't have to tell you, the decision to implement this congestion pricing was controversial, and now the decision to delay it also remains controversial. I just want to point out there were three pillars to this. Obviously, it was designed to curb gridlock, maybe ease pollution, but a huge component of this was to generate revenue that would go into fixing our subway systems here. Is this plan dead or just delayed?
Hopefully it is just delayed because it's something we really want to see happen for the reasons you mentioned. It's a source of revenue, it's an environmental action, and it will reduce traffic and improve efficiency in New York City. We have done studies that show that excess traffic congestion costs our city over $20 billion a year in lost productivity, delays, overtime, fuel costs, health, public health, and environmental action. So we're very anxious to see congestion pricing move forward.
Did you have a heads up at all from Hochul or anyone in her administration that this decision had been made?
A few hours.
Just a few hours.
Not a long heads up.
Not a long heads up. What was your reaction when they told you?
Well, I was disappointed, obviously. We've been working on trying to figure out how to create America's first urban congestion pricing zone for about 20 years, doing numerous studies. And the law was enacted in 2019 that said we would move forward with a congestion pricing district. I was on the panel that established the terms of the district in terms of what the pricing would be in order to raise $1 billion a year to support our public transit system and to achieve a targeted 17% reduction in traffic in our city, which is badly needed.
This is a huge issue. It goes beyond just politics or just how people on the ground feel about this. You mentioned that $1 billion here. If we don't get this money from congestion pricing, then where is that money going to come from, if at all?
Well, again, I'm hopeful that this billion comes from congestion pricing. And over the years, we have figured out a patchwork of ways to support our mass transit system because it's critical to our economy. So I have total confidence we'll continue to be able to do that. But none of them provide the payback of congestion pricing. We can tax, but that's purely coming out of the taxpayers' pockets. In this case, especially for the business community, if we make their operations more efficient, allow much easier, faster deliveries, have people be able to get to their appointments on time, and as well as, again, the environmental benefits of reducing air pollution and reducing public health, asthma rates, et cetera. If we can accomplish that, we'll be saving more than we're spending, far more. As I said, it's $20 billion of savings potentially versus the $1 billion in tolls that we hope to raise.
All right. Well, I guess we will find out soon whether this just is sort of a temporary pause or whether this ends up being killed altogether. Kathryn, appreciate you taking time for us. Kathryn Wylde there. She's the president and CEO of the Partnership for New York City. And we should point out she's an urban policy expert long before she got to that role here. So really understands this issue better than anyone else. All right. Stick with us here. We're going to set you up for what to watch over the next 24 hours right here on The Close on Bloomberg. All right, as we close things out on The Close on this Thursday, here's what to watch over the next 24 hours that could move the market, and that includes economic data out of China, particularly on the trade front, with expectations that their export picture actually improved in the month of May. Meanwhile, we're going to get some interest rate decisions, this time out of India and Russia. The India rate decision could be a pivotal one, particularly coming off the results of that presidential election. And back here in the U.S., the big headline of the day is going to come at about 8:30 a.m. Washington time, a U.S. monthly jobs report with the expectation for a slight uptick in non-farm payrolls from the prior month to 180,000 jobs created, and the unemployment rate holding at about 3.9%. Team Surveillance will have full coverage of that in the morning, and in the afternoon, we'll have full coverage of a live stream. This by Roaring Kitty. Keith Gill, of course, the GameStop investor, has made his return to social media platforms. He plans a live stream on YouTube tomorrow at 12 p.m. New York time. We'll let you know what he says. And of course, we'll have all the market reaction right here on The Close. Stick around. Balance of Power is coming up next here in the U.S. for all your politics coverage. And I'll be back tomorrow on The Close on Bloomberg.